The fateful day is here. U.S. jobs data is back in front of us to kick off a wild ride of event risk as we get into the final bits of 2023. It starts here with the U.S. jobs report due out tomorrow and continues next week with CPI out of the U.S. and the Federal Reserve's last meeting for the year, which should bookend a wild ride for policy expectations and for financial markets this year. Just as this key data is hitting us to start this process off, some sort of a change appears to be afoot in the markets, and the way that economic data is digested and seen seems to be evolving. And so as we prepare to talk about what this data might bring, the question that we are asking ourselves is, what matters more to markets here? Is it that we're going to get interest rate cuts next? More, less, sooner, later? But next. Or that the reason we are going to get them is that the world is sliding almost inevitably now toward coordinated recession. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to begin this conversation with a bit of evidence about how financial markets have been evolving in the way that they treat economic data. Then we're going to look at the expectations for November's U.S. jobs report, see how the data might perform relative to those expectations based on some leading information that's already come out. And from there, try to figure out if the markets do X, what is the implication versus if they do Y in the face of the data that hits the tape ultimately. So let's begin first and foremost with one more look at how things behaved last week, because there is an important clue here, seemingly. Now, we can see here that last week, a middling one for stocks, 0.7% gain for the S&P, basically flat, 0.02% gain for the high-flying NASDAQ. Crude oil a little bit lower. Gold a touch higher, but of course, subsequently it's crashed, and that happened as soon as the Monday after this result was posted. And the dollar somehow managed a minor gain. We can see here the euro, the dollar's most liquid pairing, down 0.65% last week. Now, all of that seems pretty quiet, which is a stark contrast with what's going on with the U.S. 10-year and the U.S. 2-year. Yields absolutely crashed last week. And yet, stocks didn't seem to pay much attention. Crude oil actually seemed to decline, which is not the usual thing you might expect. And the dollar, despite the fact that its yield support visibly continued to erode, actually managed to find its feet. Now, we continued this week, and the results were again a similar flavor of curious. So first we get the ADP employment change number. This is a private sector estimate from Automatic Data Processing, which is a payrolls company, a very large one. They release a monthly estimate of private sector payrolls increases and decreases, depending on what the change is, ahead of the official statistics that, of course, are going to come out tomorrow, the government's statistics from the Bureau of Labor statistics within the Treasury Department. So here, note, the number was softer than expected, 103,000 jobs added to private payrolls versus 125 expected. We got about an hour's worth of positivity out of that number, and then the S&P 500, which is what we're seeing here, then promptly cratered. Then, earlier today, the weekly jobless claims numbers came out. Now, on initial claims, we can see we are just about exactly as expected. 220K versus 225K expected. 5K here or there is not a big deal in this equation. But continuing claims, there you get a massive deviation, much lower than expected. 1.86 million versus 1.94 million. This has been an important indicator that measures the deterioration in the U.S. jobs market. Over recent months, we've seen a dramatic rise in continuing claims. What that means is that people that already filed initial claims are renewing them, which means that the labor market is deteriorating such that people are having a harder time finding a new job once they've lost one. So it's increasingly a less hospitable labor market for job seekers. And here we have continuing claims numbers that come in much lower than expected, which of course would be an encouraging sign, suggesting that job seekers can find a job faster than expected, or at least more of them could find a job faster than expected. This is an interesting dynamic once again. We get a number that's a little weaker and stocks fall. We get some jobs numbers that are a little bit better and stocks rise. Now, you'd think that that this would be the logical thing to happen, but of course, what's good for the economy is not necessarily good for the stock market, and in fact, the past year and a half have told us the polar opposite story. In fact, as recently as November, what the markets have been doing is cheering bad economic data. Absolutely thriving in it, as a matter of fact, with stocks and bonds posting some of their best performance in ages, all around the idea that what bad data means is lower interest rates. Because if there is bad data, then the Federal Reserve will cut interest rates sooner, make the cost of capital cheaper sooner, make financing any kind of economic activity, be it corporate earnings or whatever else, that much cheaper, faster. All of which the markets have been pining for since the Fed started a blistering rate hike cycle, pushing things in the opposite direction in the middle of 2021, first rhetorically then, and actually started to raise rates in March of last year. And of course, last year was defined by what? Rising interest rates and falling stocks. So, this is where these things start to get a little interesting. Last week, we got the lower yields that the markets loved in November. Only they didn't seem to really want to do anything about it. They did not sink the dollar, as was the case in November. They did not make stocks rally, as was the case in November. Earlier this week, weak data gives us a little bit of a pop. Then things turn wildly in the opposite direction after ADP. And with jobless claims, it's very direct and gives us a great test of what happens in the opposite direction. Now we have good data, and the market likes it. This has been the setup for what's been going on. In September, the Fed told markets, we think rates are going to be 50 basis points or 0.5% higher in 2024 than we told you in June. Markets go, okay. We get the higher for longer message, but what does longer mean? And the Fed pointedly obfuscated, saying, well, we don't know. And neither should you. We're data dependent. You should be data dependent. We'll see how it goes. That uncertainty turned into a jump in term premium in the U.S. bond market, which you see here in the yellow. That's additional uncertainty about where rates are going to be entering the market. As that happened, long-term bond yields rose. We can see the 10-year yield here in the red jumping because investors are saying you need to compensate me for greater uncertainty about what the Fed is going to do over a longer period of time. We don't know what the longer and higher for longer means. Then come November, Fed comes out and says, right, okay, well, thank you for the bond yield rise. You've given us the extra 50 basis point squeeze. As a matter of fact, almost exactly that we were looking for. Note here, here's 40 basis points, here's 60, so 50 is right around there. Almost perfect. So the market does the Fed's heavy lifting for it. Fed goes, okay, thanks. And with the November policy announcement, the markets get the idea, well, that's the all clear. We're done. The Fed is not going to keep raising rates anymore. And then everything turns. Bond yields decline. The front end of the curve, the 2-year rate in the green here, which before November 1st was idling because there was no expectation that the Fed was going to cut, it starts coming down because those cuts begin entering the forecast. And what we see is the yield curve pointedly shifts. So in the big dashes, we have where the curve was when the Fed met in November. Then we see where the curves have gone since. The solid line is where it is now. The little dashes there are where it was a week ago. And so we can see that over the course of November, what we've seen is a significantly dovish turn in policy. Rates from 3 months out to 3 years are now expected to be lower than they were, and the speed at which they get there is expected to be significantly greater. So already by 6 months, we're expected to shed 50 basis points, give or take. Before that, it was about standstill. Within a year, we're expected to come down by over 1%, which is a major change from where we were, again, even just a month and some change ago. So we get this dovish turn, and how do markets react? They soar. So in the red here is the S&P 500, and in the gray bars is expectations for how many rate cuts we are going to get between December of this year and December of next year. What we see is that at mid-year, we were looking at 1.75% in cuts at one point. That's this right here. And it's because we're coming off the SVB-led banking crisis and the latest episode of the U.S. debt ceiling circus. Now, as both of those things get contained, the amount of rate cuts that the markets think are needed start to come down. This is rates now being expected to end up higher than before. How do stocks respond to higher rates? They respond poorly. They go down. Once you get to an exhaustion point here, and this is, of course, the end of October, beginning of November, you start seeing this turn, again, catalyzed by the Fed. The markets go right. They're done being hawkish. Rate cuts are coming next. And you see these rate cuts start to build back out again. So at the start of November, next year was going to give us maybe 1% in cuts. Now, it's closer to 1.5%. There's your 50 basis points. But most recently here, note, stock market has stopped being able to make hay of it. As the adjustment is occurring, stocks are rallying up a storm. But here, they appear to have stopped. It's a similar story with the U.S. dollar. As the yield advantage for the dollar improves because we're going to get fewer rate cuts as far as the markets think, the dollar rallies. As it starts to build back out, more cuts, the dollar turns. And again, until recently. over the past 2 weeks, it seems to have wanted to stabilize again and is now actually attempting to crack a bit higher despite this build out. So the question we must ask ourselves is, has this dynamic irrevocably changed? Are we no longer in a world, as we have been for at least the past 6 months, as we can see on the charts here, where whatever gives us more rate cuts is good for stocks and bad for the dollar? And are we now going into an environment where that is no longer something that stocks can cheer because they are perhaps starting to look at why it is that we're cutting interest rates? And it's because the U.S. economy has all but stalled, as has most of the world economy, and a recession next year now appears almost unavoidable, not just for the U.S., but broadly speaking. And if that is in fact the case, then the very lens with which we look at news coming in and driving market outcomes has basically flipped on its head. With that in mind, the U.S. jobs report. The expectations here are for a slight warm-up. 185K expected to be added on headline non-farm payrolls. That's up from 150K in the prior month. The unemployment rate, the headline one, seen holding at 3.9%, unchanged from the prior month. Seemingly no major waves to be made here as long as we register, give or take, let's say, in line with expectations. There's always a little bit of a threshold there, but of course, it would need to be a meaningful change to really get the markets to start thinking that some number has policy expectation implications. And so, as we look at this then, the question is, are we going to get a surprise? Now, data from Citigroup that measures the way that overall U.S. news flow performs relative to forecasts has shown that the data has started to deteriorate relative to expectations. Now, part of this was, of course, the start of a strong upshift in growth expectations and bets on a soft landing as of about mid-August. And indeed, we can see this index tops around mid-August and then starts going lower. So people's expectations for economic growth got rosier. As we just mentioned, around mid-year, we bookended or appeared to bookend the SVB-led banking crisis, that version of the debt ceiling dust-up. And so people said, well, headwinds averted, growth is going to be higher than we thought in the first half of the year. So you get those expectation adjustments higher, and the data starts having a harder time beating against what is essentially a higher bar. Having said that, it is certainly unmistakable that the data continues to underperform, and now increasingly so, and by a larger margin. This index is very rapidly declining. And so what this means is that policy might get influenced or not influenced by whatever comes out, but traders' expectations certainly seem rosier than outcomes have been actually delivering on. And so whatever the Fed ultimately does with this data, the markets might well be surprised, because clearly economic data outcomes are now clashing significantly with their expectations and on the downside. If we look at some of the leading indications here, just earlier this week and late last week, we got updates from the Institute of Supply Management, ISM, on how employment has been going in the services and manufacturing sectors in the U.S. in November. This is very analogous, and in fact works the same way as the typical PMI, Purchasing Managers Index data that we look at, and is basically tracked the same way, where 50 is neutral, above 50 is growth, below 50 is contraction. This is called a diffusion index. And the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What do we see here? Well, note that for the month of November, we got a little bit warmer service sector jobs growth, 50.7, but that's but a hair above neutral and follows several months of deterioration from higher levels. At the same time, what you have is deepening job losses on the manufacturing side. So you're below 50 here for 2 months and deeper below 50 in November than October. And what that tells you is you're in a situation where the manufacturing sector is losing jobs at an accelerated rate, and the service sector is near standstill. If we looked at the S&P Global version of this same data, they put together a survey just like this. And in fact, that's the benchmark for PMIs worldwide. Typically, it's the S&P Global data. There, the situation is even worse. That data says that both service sector and manufacturing employment contracted for the first time since the heart of the 2020 COVID outbreak in November. All of which is painting this possibility that this NFP number might get worse than what the expectations have, that it might be lower. What would be the implications? Well, ostensibly, if the economy is weaker, then the Fed needs to cut rates sooner and needs to cut them more. How much more? Well, if we look at the expectations currently, they are already very assertive. By March, there's a 71% chance that the Fed has already cut rates. In fact, the likelihood that we get a rate cut at the March meeting in isolation is 56%. So we have better than even odds here that we're going to have the cut in March. Since we have some slight possibility that it comes sooner, that evens out to 71% of a chance of a cut by March. It only escalates from there. So we get the first cut already fully baked in May with a 45% chance for further easing. The second cut is fully there by June. The third one might as well be there at 2.96 cuts baked in for July. It's the same thing in September, where we have 3 cuts there and 77% chance for a fourth. That's effectively a done deal too, and indeed by November it is a done deal looking at the forecast. By December it's 5. So the market is now fully discounting 125 basis points in easing next year, or 1.25%. And then come January of the following year, already things were going below that, with a probability of 75%. So very likely. So this is really the eye-catching bit. We're at 533 now, and the market thinks we're going to 4. So that's 1.25% in cuts over just a single year. Now, that is a very dramatic pace of easing and would imply a very dire economic situation, the sort of direst that you could imagine it without an outright collapse, or maybe even with one. So there is already a tremendous amount of easing in this market that's already been baked in. So if you do get an NFP number that is a little bit weaker than expected, the natural question becomes, well, will the markets cheer any additional rate cuts on top of this already very tall pile of them that's in the forecast? Or are we perhaps in this space where the rate cuts have stopped getting bigger, the stocks have stopped going up? If there's not much more to do here, then perhaps we are in a place where we are much more concerned with the recession underlying the cuts than the cuts themselves, because perhaps the markets have baked that in already. And now a soft jobs number is going to be bad news for stocks. And maybe even good news for the dollar. Well, you might say, well, why would rate cuts be good for the dollar? Well, again, notice here, the dollar is perked up as stocks have stopped being able to rally. And this is because in times of market stress, when there is liquidation, the question naturally arises, well, if I'm going to cash out, what's the cash of choice? And overwhelmingly, it's the US dollar and also the Japanese yen, oftentimes. Although, of course, that was not the case pointedly last year, when the reason for the stock's decline was higher interest rate. It may become so again, as we've seen with the dramatic moves higher in the Japanese yen lining up with not quite as emphatic, but certainly in the same direction type of moves in yields and bonds. The yen tends to do well when yields go down and bonds go up. So perhaps we're in that kind of an environment where it's not that the dollar would rise on a bad NFP number because we have a greater yields story, a more supportive story. It's because we don't. And the markets are liquidating and stocks are declining. And the cash that they are liquidating into is very much the US dollar, the most liquid of the major currencies by a long mile, looking at data from the Bank of International Settlements, and thereby the most able to absorb volatility, and so the least jumpy in a defensive market environment. It could be that the pendulum is turning, and if the market is then unable to rally on soft data that ostensibly might have signaled even lower rates and even greater cuts, perhaps even sooner, well, then we're probably looking at a dark December ahead. Because everything that's powered stocks up to this point has been expectations of lower interest rates, at least in recent months. Let's call it the past 6 months. Where stocks have rallied, it is because greater cuts were expected. That was the case here. More cuts, stocks rally. That was the case here. More cuts, stocks rally. Certainly the case here. But if that's now changing, and bad data is no longer good news for markets, well, then we might end the year on quite a whimper. And that is Macro Money for today. As ever, we are here Monday through Thursday, making this the last show of the week. We're on right after Overtime, which is a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened on Wall Street on a given day and what that might mean going forward. I'll be back on with Chris tomorrow for Futures Power Hour, as I am every Friday. We'll talk about what this jobs data does and did, see what ultimately it started to touch off in markets. I'm back on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, @IliasPivak. Thanks very much for joining. Happy trading. Talk to you soon.